I just wanted to quickly take a look at what we have coming up in earnings. In other words, I think I've answered all the questions that have come in, but if anyone here online has any last minute questions, go ahead and send those in as well. All right, so coming up on the 26th, what are we expecting here? Hasbro, F5 Networks, Lockheed Martin, Range Resources, Tata, and Tesla. Aftermarket, AGNC, Alphabet, the Googles coming on 7/27, all two, aftermarket. Starbucks, CRISPR, Juniper, Visa, Microsoft, Mattel. This is just coming up in the next week to 7:30. What's the last one? Okay, Apple is on 7:30 as well. Okay, I didn't realize that. I didn't realize they did that. Well, is that confirmed? We can take a look. Oh, wow. Okay. Oh, no, it is 7/27. Okay. Sorry. Apple is 7/27. I apologize. For some reason, I must have been looking at the wrong column there. It shows the 30th, but it's 27 here. I was looking at the wrong column. What was confusing me is I'm seeing aftermarket for Apple on the 30th, and there's just no way they would allow a Friday report to be aftermarket. In that case, this was for the straddle that's shown there. Okay, so that's the earnings dates. Good. Going into next week up to 27. Some good names there and some other smaller names. Visa. Essentially, I didn't see if Microsoft already reported yet, but you got Google in there, Starbucks, Tesla. Going to be an interesting first part of the week, I can already tell. Honeywell and Schlumberger. Oh, there's American Express. Okay, and Kimberly-Clark as well. Oh, those were today. American Express was today. Okay, good. So don't know if MasterCard reported earlier in the week also. Oh, Chuck, I'm sorry, Chuck. Chuck says, when discussing bull call debit spreads, you mentioned that you scanned for a delta ratio less than 1. Okay, my debit spreads, bull call debit spreads look for a debit ratio of greater than 1.05 if set to what I get spreads where the debit is more than the difference in strike prices. I think we got confused in the terminology. I personally don't use delta ratio in a bull call debit spread. I don't use that filter. I think you using a filter of 1.05 is fine. I was talking just in diagonal spreads. Diagonal spreads is the only search that I use the delta ratio, or look for greater than 1.6. And the other filter that only applies to a calendar spread, Chuck, that I was mentioning, is not even here in the bull call debits. The debit to strike difference ratio has to be less than 1. So I'm paying a net debit that is less than the difference in strike prices, so that if I do get assigned early, I still have a guaranteed profit on the position. Whereas I don't want it to be too high, because then you won't have a profit, as you mentioned, when looking at it in the debit spread field. But that filter isn't even here. The delta ratio is here, but the debit to strike difference ratio, which is only available in the calendars, is the one I have less than 1. Okay, you said greater than 1.05. And what is delta ratio? I'm sorry, it's the delta of the long divided by the delta of the short in that case. All right, so just a miscommunication there on strategy terms. The debit to strike difference ratio of less than 1 is only used for the calendars. The bull call debit, I personally don't use a delta ratio, but maybe I should start looking into your advice and your suggestion and start looking for ones greater than 1.05 and see if that enhances any of the potential returns. But these are the in the money ones. Your deltas might be a little bit different. I understand that if you're going longer term in that case, 30, 40 days out using an at the money. These are in the money bull call debit spreads for higher return percentage in a shorter time frame, a better probability than the at or out of the money 50% bull call debits, which can be very profitable as well. Yeah, okay, that's good. And he didn't. I'm sorry. There were 3 underlying. Yeah, you're doing the OTM debit spreads, Chuck. Excellent. Well, let's clarify that. Someone just asked, what's an in the money versus out of the money debit spread? Great. Let me go back to that screen. So here, Skechers is trading at 54.22, and this is a weekly bull call debit spread, very similar to what we might look for in a weekly bull put, where we're selling an in the money or a strike below the stock price at 52.50 and buying at 51. We're looking for a 75, 78, 80% probability the stock will be above the short call strike price. Probably would go with the higher one personally for me, the 52, 50 here, with an 80% probability and a 27.7% return. We're in the money on this credit spread, debit spread, which is a parity trade to if I sold the out of the money 52 put and bought the out of the money 50-50 for a bull put credit spread. Okay? We're looking for a good probability of getting assigned and earning the max return. But what many investors like to do is go further out in time, similar to some of the discussion we had back on the calendar spreads when I was talking about if I just want to be assigned on a position, I'm going to use an out of the money debit spread and pay less for the long call than using a diagonal or buying a call that's further out in time. Not to confuse you there, Jim. I'm sorry, Jim was the one that asked this question. Not to confuse you there on that one. So there's our, again, in the money bull call debit spread. We're below the strike prices. Paying a fair amount of cost here, but we're getting a fair amount of cost back, looking to make good 25-15% profit on the position with a higher probability. But if I was more bullish on Skechers over, say, a 20, 30, 40-day period, let's go 35 days out, what I might do is buy a slightly in the money or at the money call and sell an out of the money or at the money. So I'm going to do the 53.55. This is above the current stock price, so it's out of the money. The 53 is at slightly in the money. So we're going to buy the 53. Remember, we were looking at a 27% return on the position, that original one, where we had a cost of 117 to make 32.50. But we've got a 80% probability of getting that return of 27%. With the at the money spread, you have less than a 50% probability, but what you're looking to achieve is closer to a 1-to-1 risk-reward ratio, Jim. So in this case, my debit's lower. It's only 107.50. I'm paying 327, 328 for the long. I'm getting 220 for the short, so I have a lower net debit. And I'm paying 107.50 to potentially make 92.50. Or let's just call it 108 to potentially make 93. I'm really close to a 1-to-1 risk-reward ratio. The other position that we saw, the in-the-money debit spread, was a debit of a higher debit here, around $2 to make 32 cents or so, I believe. So you're looking at sort of a 6-to-1 risk-reward ratio, but with an 80% probability of success. That's the trade-off between an in-the-money bull call debit spread with a higher probability and the out of the money bull call debit spread, a little bit more speculative, but where, as Chuck mentioned, he wants this close delta ratio of greater than 1.05 because he's looking to sort of get a 1-to-1 risk reward ratio on the position. And that's an out of the money debit spread. Again, the probability of the stock being above 55 might only be 50, 45%. 50% probability as opposed to 80 of that other trade being successful, but you've got a more controlled 1-to-1 risk reward ratio, and that's how the OTM debit spreads are used. Never do the parity trade. What do I mean by that? This is a debit spread. This is our bull call debit spread. We're selling the call here at our strike of 55, and of course, we're buying I said the 53, right? Yeah, we were buying the 53. It's right there in front of me. Now, this is a call. It's an out-of-the-money call, but if the stock moves up, I may be obligated to deliver shares of stock at this price, and that's fine because I've got this to buy it, to deliver it, to get the $2 back and make my maximum profit on the position. I had mentioned a little while ago that the in-the-money bull call debit spread with the 80% probability is a parity trade to using the same strikes for a bull put credit spread, where I'm selling this put, buying this put, receiving a credit up front, and I'd still make that same maybe 25 or 27% if the stock stays above both strike prices. They're called parity trades of one another when you use the same strikes and the same expiration, bull call debit, bull put credit. You would never do this parity with a bull put. Why? Because now what you're doing is you're selling an in-the-money put on Skechers, and you bought a further out of the money put. If the stock stays right here and you get assigned early, you now have to buy these shares of stock at 55. This isn't covered yet. This put here, the deeper out of the money put, is covered only to limit the loss if it suddenly tanks and falls against you. So you don't do an ITM credit spread Sorry about that. You don't do an ITM credit spread because that short option is hanging out there in the money and risking early assignment where the protection doesn't come in till way down here. This structure, at the money, out of the money, is only preferred for debit spreads when we're talking about the vertical spread positions, not the credit spreads. Stick to out of the money on the credit spreads, high probability 80, 85% or more, Jim. That's what you want to look at. But this is the comparison of the OTM debit spread to the in the money, and this is why it's done to get better to that one-to-one risk-reward ratio on the positions across the portfolio. All right. Okay, well, ladies and gentlemen, we're at 5:23 p.m. Eastern Time. If you have any last-minute questions, go ahead and send those in as well. I just wanted to see if we've updated today. You know, sometimes the market sentiment updates. I think it did. It was 2 and 11 when 2 bearish, 11 neutral, I thought, when we started the presentation. We're now at 2, 10, and 1. I want to see how our percentage of stocks over SMA 20 changed, if it did. Yep, it's back up to 40. Okay, so it had dropped down to 33. The earlier part of our presentation, we saw it had dropped down to the low there of below 20, it looks like, actually, in this one. Let me go back to that quick view. Yeah, it was about 1750. Only 17.5% of stocks were trading above their 20-day moving average. Now we're back up, peaked up to 40 here. Now we're back up to 40. As this ran, excuse me, when we were doing the webinar in that case. So I was just curious to see how the market sentiment tool would have changed there from today's trading after what happened in the past week there as well. There we go. So I just want to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or trading suggestions. I'm not opening a spread on Skechers one way or the other next week, as far as I know. But if I run my search and I see some good opportunities, I might do one. But again, you won't know that. And of course, options do involve risk and may not be suitable for all investors. Now, if you like some of the tools you saw today, we went through the search tool. We discussed using the profit and loss chart to analyze diagonal spreads, showcase some of the basic features of the portfolio tool, and more. Remember, you can take a 14-day free trial at any time. Just go to powerop.com and then put in your name and email address. You'll have full access to the site for 14 days, no credit card required. You also have limited use of the historical backtesting tools. You saw me use one of those little features when we were looking up the historical prices for NVIDIA to find out when the date of that 4-to-1 split as well. You have full access to the site for 14 days, and every trial member, of course, can schedule a coaching session at any time. After the trial, subscriptions start at just $45 per month for the end-of-day service. The delayed service, where the data is updated every 15 to 20 minutes, is only $65 per month. And you can cancel at any time. There's no contractual obligation. There's free coaching available on all levels of subscription, of course. You can also upgrade anytime and have full access to all the webinar archives. Speaking of webinar archives, remember, just click the free webinars tab underneath the main home tab to access the webinars pages and scroll through the different topics and sections there. Or you can just go to our YouTube channel, Power Options YouTube channel, go into the video section and just run a search there for covered call, calendar spread, poor man's covered call, credit spread, for example, and you can scroll through the videos on those topics. We try to keep the naming conventions similar to what someone might search for as well. Well, if you think of any other questions over the weekend, remember you can send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And of course, again, any trial member or subscriber can schedule a coaching session anytime. That's essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site, answer any questions you have, very similar to what I do here, just it's on the phone rather than in a webinar format as well.